Hey guys, Pup of Wall Street, and today we're going to be going over if I were to open up my own Roth IRA right now, what would I put into it? That's the definition of a Roth IRA. It's a tax-advantaged retirement account. It's tax-free when you withdraw the money. Alright, so I'm going to say this at the beginning of the video because it's super serious because this is people's retirement accounts. And what I'm going to say is I'm not a licensed professional. Do your own research. But yeah. Do your own research. Don't just follow what I or any just finance YouTubers just says to do. You can't just do that. You gotta do your own research. But yeah, that said and done, let's go into the first. Now, all these ETFs are from Vanguard because I just love Vanguard. They're super trustworthy. And yeah, I prefer to put safer investments into obviously a retirement account because it needs to be safe. You want to trust your retirement account to give you a stable income in the future. You're relying on it. The first one is Vanguard's Russell 2000 Index. Now they have an expense ratio of 0.1% and a dividend of 1.41%. If you look, they do grow in the long term. They're small cap, so small and micro cap stocks. So companies not like Microsoft, Amazon, Procter & Gamble, Johnson & Johnson, Intel, they're companies that are smaller, that are going public. So like they're barely going public, kind of. They don't have large market caps. So if we look at their holding, most of them are companies that you probably haven't heard of. And yeah, you can see that since there's 2,000 holdings, though, the percent of each stock is barely anything. It's not even 1% of the whole thing. So yeah, this is pretty safe. There's a lot of stocks in it, and that's why I love them. You can't go really wrong with them. The only thing that I don't like about this ETF is that it doesn't yield as much return as VOO, the S&P 500 ETF. You can see this yields far more return in the long term. This has a smaller expense ratio of 0.03%, a dividend yield of 1.88%. And what I recommend with these dividends is let them reinvest. Alright, that creates compound interest and increases your income every time the dividend gets reinvested. So when you're retired and you want to live off just the dividends, maybe you could live off that income, and that income would be higher as if you weren't to reinvest the dividends. Alright, although I don't know what you would do with the dividends in a retirement account if you're not reinvesting them. Alright, their holdings are pretty big companies, the opposite of the Russell 2000 Index one. It's Microsoft, Apple, Amazon, Facebook. You probably know every single company in here. This is Warren Buffett's company, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble. They own Procter & Gamble. You might not know them by the company name, but they own Colgate, Oral-B, some other Charmin, Bounty, like those stuff that you'll use every day, consumer staples. Alright, that's VOO. Another one I would recommend is if you don't want to go with VOO, although I chose VOO because it yields higher return in the long run. But if you don't want to go with this, I would recommend VTI, or VYM, which VTI is Vanguard's total market ETF, and VYM is the dividend specific ETF. Speaking of that, the next is VYM, Vanguard's high dividend yield index fund. Now, I put this in because I think I rather go with this. It has very similar companies to VOO, just it prioritizes dividends. So they have an expense ratio of 0.06%, still very low. And they have a higher dividend yield of 3.75%. They do grow, but not as fast as VOO. Their holdings are more dividend-known companies. Johnson & Johnson, JP Morgan, Procter & Gamble. You saw Procter & Gamble and Johnson & Johnson on VOO, but they were a smaller position. You buy them for their dividends and small growth. And you can see all these are known for their dividend. ExxonMobil, AT&T, Pfizer, American company. Yeah, they're all dividend companies. I'm pretty sure these top three are dividend aristocrats. I'm not sure how the others are. I'm pretty sure ExxonMobil is too. Not sure. That just means that they have increased their dividend for the past 25 years. So yeah, I'd probably go with this because I probably want to live off income more than selling the stock or the asset or ETF, whatever this is. I'd rather live off the income it generates me, not the return on not the capital gains. Next, so we got those over with. Now we're going to go into my favorite sectors. So these are going to be sectors that I believe in the long term. Now this might be different based on person to person. I think these sectors will do really well in the future. Someone else might prefer a different sector. So this is optional, and this is totally your choice. First one, we got their Consumer Staples Index Fund. So this does grow in the long term. They've been slowing down recently. I don't know if you can notice that. But their yield is 2.71%. Their expense ratio is 0.1%. So that's a bit higher than the other ETFs. Their holdings are consumer staple companies. Called it. Procter & Gamble is the first thing. Coca-Cola, PepsiCo, you know what they do. Walmart, you know what they do. Philip Morris International, they make cigars, tobacco products. Costco, and then so on. So yeah, they're just consumer staple groups. Consumer staples are stuff that you buy every day. We require, unlike consumer discretionary, which like if we have an extra money, we might buy Starbucks or something. But consumer staples is stuff we need: toilet paper, toothpaste, yeah, food, stuff like that. All right, but yeah, they do tend to have a higher dividend yield than most companies. That's why the dividend yield is higher. It's at 2.71%, so I would also probably reinvest this high dividend yield in the dividends, because a lot of dividends with this high dividend yield. Yeah. Next one is real estate, because I believe in the real estate market, obviously. They did get really hit hard in 2008 because of the financial crisis. It had a lot to do with real estate, but they're starting to make a recovery, but they have been slowing down recently. Their net expense ratio is 0.12%. Their dividend yield is higher than VYM, the dividend specific ETF, of 3.96%. And that's why I like real estate, because it tends to give out higher dividend yields. Let's go to their holdings. It's all in real estate. Tiny bit in financial services, but it's all in real estate. All right. All right, and then the top position is their other real estate index: American Tower, Crown Castle International, just real estate stuff, companies that have to do with the real estate market. All right, I love real estate. We're always going to need shelter, somewhere to live. People are going to need property to get work done. So that's why I would put this in. And then the last sector-specific ETF I would put into this portfolio is VGT, the Technology Index Fund. Now this one has a lower dividend yield than all of them, but that's because technology is focused on growth. You can see I am clicking on max for all the ETFs because I want to show you what it's done in the long term. When you're holding stuff for retirement, you're looking to hold it for many years. Yeah, that's why I'm looking at this. This starts in 2004, so that's 16 years that you'd have to hold this. All right. So it's basically, they have an expense ratio of 0.1%, a low dividend yield of 1.8%, 0.08%. If you look at their holdings, it'll be like Apple, Microsoft, and stuff. Ha! Perfect. Apple, Microsoft, and stuff. You got Visa, Intel, MasterCard, Nvidia, Cisco, Adobe, PayPal, and Salesforce. Actually, I own a lot of these companies in my normal portfolio. Salesforce, Microsoft, Apple. If you want to check that out, that was my last video. I revealed my portfolio as a 14-year-old. And yeah. So, yeah, information technology, just technology. I think that will be really big in the future because now that the technology sector has been booming, I think it'll keep on booming. There's so much innovation, it's moving so quickly, and yeah, I'm probably going to hold them forever. Next, we're going to get into some boring stuff. We got the Vanguard Total Bond Market ETF. They don't grow too much, but it's nice to diversify. I know you don't have to, this is like an optional one. If you want to diversify like me and play it safe, their yield is 2.5% and an expense ratio of 0.03. You can look at their holdings. The majority is just in bonds, mortgage, treasury notes. Yeah. It won't appreciate that much over time, but it's stable income that most likely won't change over time. And reinvested dividends, that's the only way you can take advantage of growth with this. Next, you got Vanguard's Total Stock Market ETF, VXUS. Now, this is also optional. The odds are I won't put this into mine, but this is great for some people. You could either substitute it for VOO or VYM, because that's like, you need, I prefer to have at least one of those in the S&P 500 dividend specific ETF, S&P 500 ETF, or total stock market ETF. All right. Oh, read it wrong. Vanguard Total International Stock Market ETF. So yeah, when I was saying the total market ETF over here, I was talking about the American market, by the way. Now this is the international market, just in case the American market isn't doing so well for the next couple of years, you can rely on this one. They have a yield of 2.61%, expense ratio of 0.08%. Yeah, it just tracks every country's like large cap stocks. It's a good look. If you look down, you can see Alibaba, big company in China. Nestle. I don't really like Nestle. Nestle's not morally, I don't like to. I would rather not invest in that. See, Taiwan, probably Samsung. I haven't heard of most of these companies. Toyota, I'm pretty sure they're a Japanese company. Toyota, not sure, but yeah, I don't really know many of these companies, but it helps diversify into the international markets. So yeah, that's what I recommend to invest in for what I would invest in right now, not what I recommend for you. You might be in a different situation. So first you got your Russell 2000 index, which gives you small cap exposure to small cap companies. You can choose between, I'll choose between Vanguard's S&P 500 ETF, which just gets me to large cap US companies, or just the same thing, but this is dividend specific, less growth. Or you can do the total market ETF, which is VTI. Next, we got my favorite sectors that I think will do well by the time I retire. Consumer staples, which is just companies like Procter & Gamble, Coca-Cola, PepsiCo, stuff we need. The real estate market, you know what real estate is, just owning property. And technology, which is primarily growth. Then we got the boring stuff, bond market, which is not much growth, but you're focusing on that consistent income. And the total world. This is like an index of the total world's economy, the entire world's economy, basically. But yeah, thanks for watching, and I'm going to say it again, please do your own research. I am not a financial advisor. I'm not a professional in this field. You have to do your own research. You can't just buy into anything that I or any other finance YouTuber says. But yeah, thanks for watching. Please like and subscribe. If you want a free stock, use my link to Robinhood in the description. And see you guys next time.